All right, let's talk about IRIDEX Corporation. Now, this is a really interesting one because on the surface, their second quarter earnings looked pretty good, a solid beat. But the market absolutely hated it, and the stock took a nosedive. So today, we're going to dig in and figure out why a good headline can sometimes hide a really bad story.
So, at first glance, these numbers look great, right? IRIDEX beat what the analysts were expecting, both on revenue and on earnings. You can see revenue grew 7% compared to last year, and their earnings per share, which is a key measure of profit, also came in better than everyone feared. But then, look at the market's reaction. The very next day, the stock got hammered, down over 9%. So what gives? That is the puzzle we need to solve. What did investors see that the headlines completely missed?
And that's the million-dollar question, isn't it? It's this kind of disconnect that tells you there's a much deeper story going on, something way beyond the simple top-line numbers. To get to the bottom of it, we've got to look past the headlines and get into the nitty-gritty of how this business actually works.
Okay, first things first, let's give credit where it's due. To really get the full picture, you have to see what management got right. They've got this, what they call a self-help story going on. And you know what? It's showing some pretty impressive results, especially on the expense side of things.
I mean, look at this number, a 28% cut in operating expenses from one year to the next. That is some serious discipline. And this wasn't just a one-off thing. The CEO, Patrick Mercer, he made a point to say this was the third quarter in a row they've managed this kind of cost control. It's a huge reason they were finally able to hit positive adjusted EBITDA.
And all this cost-cutting, it feeds directly into what they've promised Wall Street for the rest of the year. They are dead set on hitting cash flow break-even, delivering that positive adjusted EBITDA, and doing it all while keeping revenue steady. You're looking at a management team that's really trying to build a stable, profitable foundation for the company.
Okay, but here's the but, and it's a big one. This is the reason the stock got crushed. While they were doing a great job managing all those expenses, a really serious problem was popping up further up on the income statement. And this is the part that totally spooked investors and just overshadowed all that good progress.
Yeah, and this chart, this tells the whole story. Gross margins absolutely collapsed. They fell by 620 basis points. We're talking a drop of 6.2 percentage points in just 1 year. Going from over 40% down to under 35% is a massive, massive red flag, especially in this industry. This is what the market saw, and it immediately made them question how high quality that earnings beat really was.
So, the big question is, why did the margins fall off a cliff? Well, it all boiled down to the kind of stuff they were selling. See, they sold a lot of their lower-margin hardware, the big laser consoles. That's what pushed the revenue number up and got them the beat. But their high-margin recurring revenue business, the G6 probes, the consumables, those sales were weak. They actually fell. It's like the classic razor and blades model. Investors want to see you selling the blades, not just the razor. And IRIDEX sold a lot of razors, but not enough blades.
Now, to their credit, management isn't blind to this. They know it's a huge problem, and they came to the earnings call with a plan to deal with it. So let's take a look at their turnaround strategy. So here's their three-pronged attack. First, they're going to try and negotiate better prices with their manufacturers. Second, they're planning to move the entire company to a smaller, cheaper facility. And third, they're going to refocus the sales team to push those high-margin probes. But, and you got to pay attention to the timeline here, these are not overnight fixes. We're talking about a facility move that's still 2 years away. For an investor, that just screams execution risk.
Okay, so let's put it all together. You've got this great story on cost control over here, but this ugly looming margin problem over there. How do we weigh these two conflicting stories to figure out where the stock is headed next?
You know, for every investment story, there's usually one thing, one single factor that everything else really hinges on. We like to call it the hinge point. And for IRIDEX, it's not even a debate. It is all about fixing those gross margins. Until they can prove to the market that they can sell the right mix of products and get those margins stable again, the cost-cutting story just isn't going to be enough to make the stock work.
And if you need any more proof that the market is watching this like a hawk, just look at how the stock has performed. The entire medical devices sector has been more or less flat for the past year. Meanwhile, IRIDEX is down almost 30%. The market is practically shouting at them, "Show us the margin recovery."
Which brings us to our call, the bottom line. We are initiating coverage on IRIDEX with an underperform rating. Look, we applaud what they've done on the cost side, we really do. But the margin problem is just too severe, and the turnaround plan has too much risk and is too far out in the future for us to get positive on the stock right now.
So if you happen to agree with this view, how might you play it? Well, for a trade idea, you could look at something like long-dated put options. Those are basically a bet that the stock price will fall. Specifically, you'd look for options that expire after August 2026. This would be a direct bet on the execution risk around that big facility move. These kinds of transitions are notoriously difficult, and if there's any kind of stumble, it could really hit the stock.
And, as always, we have to say it, this is not financial advice.
So we'll leave you with the one question that really defines the whole IRIDEX story right now. With a tricky product mix and a very long road ahead, can cutting operating expenses ever be enough to fix a fundamental problem with your gross margins? We know what we'll be watching on the next call.